Welcome to the Value Investor Chatter podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my co-host, Hari.
Hello.
Welcome to the podcast, everybody. Before we get started, let's do a quick disclaimer and get on to the topic.
This is the Value Investor Chatter podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors, nor do we know your specific financial situation. So please consult with the appropriate advisor before making any financial decisions.
Excellent. So before we dive into the topic, I just want to do a quick plug here for ourselves. If you guys do enjoy listening to our podcast, please leave us 5-star review wherever you get your podcasts, and like and subscribe and leave us a comment. That really goes a long way. Also, if you guys want more resources to learn about value investing and any resources that can help you out in your value investment journey, please go check out our website, valueinvestor.org. In there, you also have access to all of the blog posts that we put out. There is the investment checklist that we use to analyze companies. You can get that for free. Also, the database is available for free. Anybody who would like to look at the fundamentals data for all the companies that you guys analyze, for example, we're showing Apple, that's all for free. So here you see income statement, balance sheet, cash flow statement, all the way going back to 1995. So we did the hard work to make this into tabular data so that you don't have to scrape through the SEC websites or their 10Ks. So have at it. It's for free. Come and check it out. All right, let's go dive into the topic of today, which is just a broader comment on the state of the economy and where things are going. Last episode, we talked about what's happening with the Silicon Valley Bank and that the implication and why that is happening. I think we should really double click on that and see and explore some of the nuances there and what that means in the broader picture of the economy, given high inflation and the interest rate. So start us off, Ari.
So one of the big things about the economy right now is we had unprecedented levels of interest rates. So at the very lowest levels that they've ever been in some cases zero, right? So what that means is money is essentially free, right? So people were pumping money into stocks and pumping into money into all these things because the borrowing costs were so low. Well, then when the federal government in the middle of the pandemic started pouring money into the economy, it caused inflation. And now the inflation is causing them to raise interest rates to kind of slow down the growth of prices and other things. Well, this has some side effects that are now impacting banks. So we talked about Silicon Valley Bank, but there are two other banks right now, Signature Bank and First Republic, that are being hit. Signature was taken over. First Republic got cut in half, essentially, in terms of stock price. But this is actually causing a huge problem because when the banks are unable to pay their creditors or their depositors back, they have to sell some of these interest bearing securities that they have, which are bonds that were very low yield interest rates. Well, if they bought those 2 years ago when interest rates were much lower, the bond coupon was $100 is typically the bond price, and it yields 1%, 2%, whatever it was. Well, when you raise the interest rates, the bonds that you have, if you hold them, there's no impact. You just collect the money, and then at the end of the term, you get the $100 back. But the problem is when you raise the interest rate, what ends up happening is if you have to sell the bond, nobody wants to pay $100 to get a 2% yield. They can just buy new bonds from the federal government at a 4% yield. So they have to actually reduce the price that they paid. So they paid in initially $100. Now they have to sell it for $80, to get the equivalent, or it's actually even less. And so they're actually going to take a loss, right? Well, That's exactly what Silicon Valley Bank did, and that shortfall ended up causing them to have to raise money. So Credit Suisse, which is a big bank, was getting hammered. Actually, announced that they were getting a loan from another banking institution. So what this is all leading to is uh, recessions are typically caused by a pullback. Everybody gets nervous, so they stop spending money, start hoarding cash to prevent losing any money in bad investments or debt. And this is where, in the past, what we would do is cut interest rates. Well, you can't cut interest rates because you're going to cause more inflation. So this is the big thing that everybody is concerned about, is called stagflation, where the economy is stagnant because people don't want to spend. It's going to take care of itself. It's just going to be something that could get very ugly, because in a recession, the typical response is the federal government goes in and you know uh, prints money and tries to get the economy going again. Um, so anyway, this is kind of what's going on in the market right now. Is you're probably seeing big fluctuations like the last few days, where the market is just tanking 300, 400 points. And what is causing all of this is so much uncertainty. People are pulling their money out. They're firing employees. They're holding on to cash, and this is going to cause the effects of this are going to be a recession.
Yeah, I think one of the key points here is that usually when this happened, right, in the past, when this happened, Federal Reserve and all the central banks in unison could come in and step in and basically provide cushion for the economy, right? The economy was on life support. The life support itself was provided by the big banks, the big, the central banks of the world. Now they can't really do that, because if they do that, they're just going to worsen the inflation that they are trying to fight at the moment. So that's where things are. I want to transition into more tactical things and think about what does that mean for investors as they look into some of these companies. Banks are one of them. Some of the names that you and I like in the tech space, in the non-tech space. What does this mean for you and me as an investor? What should we be looking for?
Yeah. So if you're looking for actual stock picks, that we talk about, you should come to our website and sign up to be part of our community. So one of the we have several companies that are actually going on sale right now, and a lot of those businesses are cheap because they're misunderstood by the economy, by the market, right? And that's where value investing really takes place, right? So what you really want to look for is businesses that have solid operating, platforms that are not going to be. They may take a hit during a recession, but are able to sustain themselves, pay off their creditors. Hopefully, they have very limited amounts of debt that they can account for, and then they have a lot of cash that then will allow them to get make good investment and capital allocation deals during this. Now, what I just said applies whether there's a recession coming or not, right? And that's the important thing, is you want to own a good business both in good times and in bad times, right? Because you don't know when the bad times are coming, so just buy the best business at a fair price.
Yeah. I think this is one of the things that Warren Buffett talks about, where if it's raining gold, you want to have enough, you want to have big bucket so that you can go out and catch all those goats that are falling from the sky. I think right
Yeah.
now, with the market down as it is, and perhaps it's going to go even more, it's going to have even more pain in the coming weeks. This would be a good time to actually exercise some of those value investing fundamentals out in the market, because as you and I are seeing, there are a lot of discounts out there with companies with good
Yeah.
operating profile and good margin profile that are able to have those margins, that are able to protect the integrity of those margins even in a down market like this. They look extremely attractive right now.
Yeah, and one thing I would say, Becco, is the more I've done this, the more I realize the importance of how having a manager aligned with your interests, how critical that is, right? We talked about our checklist, um, and if you have if you have management that is going to look out for their own interests above and beyond yours, then they will, right? And so what will end up happening is you'll be pumping gas out of the ground, when it's losing money, because the CEO gets paid by the number of barrels that they pump, right? So you want to be looking for a guy or gal who owns some significant percentage of the business, and when the share price goes up, they benefit just as much as you do.
Hmm. Yeah, I mean it's a rare find when you see one of these companies that actually has the incentive structures aligned to the shareholders, because some of these things change over time. So, for example, every year the compensation committee and the board will set the compensation structure for executives maybe differently. There's also personality changes that happens. There's the X factor of just having um, gelling with the company by itself. There's a lot of things that go into play here. So, I mean, I think the best kind of CEO that I've seen are the ones that are personally invested in the company, not just financially, but also there's some X factor involved in there. So, for example, if you're a founder of a company, for example, I think that's a really good sign that I like to see. Oftentimes, that's really not. It's not. It's very rare, but that's one of the things that I look for in the management side of things in the checklist. Yeah.
Yeah, and I mean, we have a company that we're going to just publish for our community here. That is, the insider owns 25% of the shares outright, and is yielding almost 10% as a dividend, right? And it's a great business that is the the owner manages the company and knows exactly what's going to what's in his best interest, and allocates capital in a way that maximizes shareholder value. And that's why it's important to look for those businesses, because you're not running the day-to-day company, right? If the owner of the business is you, but you're in the same elbow to elbow with the guy who's actually running it, that is a good position to be in, right? And especially in difficult times, because they're going to allocate capital for the overall company's benefit.
Yeah. I've seen some examples where even if you and I invested in a company, and perhaps you still hold this company, you and I invested in a company where the found or not the founder, the CEO had a large percentage of the company,
Yep.
but it still didn't materialize in a positive upside for the share price for the last few years.
Right.
So it doesn't mean that this is the magic bullet. It's just one of the things that you have to look for.
Yep.
Yeah. Let's move on to this new topic of AI. You and I are, you and I both work in the tech industry. You and I both work in the healthcare tech industry, which is a subset of health tech industry. AI has been making a lot of noise, and you and I both use ChatGPT and GPT. What do you think about its impact, and transpose that in the greater commentary about the economy?
So, whenever you look at technology that's kind of disruptive, right? In the early 2000s, it was really the internet, right, that was taking off, right? You had the first wave of the internet. It kind of wiped out a bunch of trash businesses. And I think what we're going to see here is there are a lot of people who are afraid, right? People who are typically doing a lot of like writing and things like that, or if you're using Mid Journey, like artists and stuff like that, that are afraid that this is going to replace them. It's going to but what people forget about that, and there is definitely going to be disruption in that sense, right? But what these companies also allow and enable is more productivity, right? And so when productivity enhances, this is where you are able to actually get more for less, right? And this is the most important thing about technology, right? The entire point of technology is to be able to take the same thing and make it cheaper, right? If you look at your TV, right? if you wanted to buy a 65-inch TV 20 years ago, it would cost you, $5,000, right? Now that same TV you can have for $500, right? With better technology, it's more energy efficient. All of it's got better colors, blah 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 blah, right? So really, what people need to start looking at is like there's a lot of ethical issues that I have with these AI tools because they are built without permission of a lot of the source material, right? So I think that is extremely problematic, especially for artwork and stuff like that. Um, but I mean, putting that issue aside for a moment, and let's say that they are able to figure out that ethical problem, right? This is really about productivity for a lot of people, right? If you're not a good person in marketing, but you're a small person, two-person shop, and one person is not really great at writing copy, they can use ChatGPT to, kind of enhance that, and they're not, paying for a marketing person, right? So this enhances their productivity, makes their dollar go further.
Yeah. I think doing more with less. I think that point well taken there. I think I think also another thing that I think people should think about is this is going to unlock a lot of talent overseas. That's another thing that I'm seeing personally. One of the reasons why you can't, it's very difficult to hire offshore talent are a few different reasons. One is the coordination cost. If you're in the U.S. and you want to hire somebody in India, for example, or in Russia or Ukraine or wherever, one of the challenges is obviously the language barrier. With ChatGPT, some of that gets smooth. I mean, it doesn't go away it doesn't go away completely, but it does smooth things out a bit, and that's what we have experienced, you and I, in our personal
Yep.
businesses. So I think that's going to be a major unlock for cheaper labor elsewhere because money is going to try to find cheaper labor wherever it could. One area that I think is going to be interesting to watch is what is it going to do to the regulated industries? Because to the point of, okay, technology is going to drive efficiency, technology is going to drive productivity. That's sort of the rule, except in regulated industries. If you look at doing more with less, that's exactly opposite of what happened in the healthcare industry, for example. You and I both know that healthcare, if you chart out the inflation rate in the healthcare cost, healthcare inflation with everything else, it's like number one.
Yep.
Even with a lot of new innovation and productivity, the number one inflation right now in this country, and probably in many other countries, is healthcare. So, and if you look at the reasons why, a lot of times it's because it's a very regulated industry. So it's really hard to innovate. It's really hard to find these opportunities to innovate. It's very calcified environment. So I'm excited to see what it will do to unlock some of those efficiency gains in regulated industries. It's to me, it's about time.
Yeah, and one of the things that is very interesting about healthcare is, if you like we were talking about technology, the price has gone down over time, right? Healthcare, the price has gone up, right? And that is largely because they're not increasing productivity, right? If you ask most physicians and nurses and all of that, they're much less happy than they used to be because they're having to do more paperwork, more charting, more documentation, more, et cetera, right? And the reason for all of that, the reason they're doing all of this extra, kind of work is the technology that they have is actually making them just do more busy work, right? So, and like you say, this is all because of regulation, right? Oh, we got sued last week, so we need to increase the number of things that we click on and document, right? And that means that if you have to keep doing that, you're clicking on stuff just to make things go away so you can get your job done, right? So this is kind of the catch 22 in healthcare, and this is actually not just healthcare, but if you look at the cost of education in colleges and stuff, right? I mean, if I've learned actually more from YouTube in the last 5 years than I did in college, right? More about history, more about economics, more about just about anything, right? The value of a college education should be basically like something that you could get for free. Um, but if you go to colleges nowadays, it's gone up by 5 to 10 times, the price that it used to be 10 years ago, 20 years ago.
Yeah. Yeah, I think there's going to be a lot of efficiency gains, alternative methods to achieve the same outcome. It's going to be interesting to see. And as you talked about earlier, this is where companies that really know how to innovate and stay on top of things and drive productivity and efficiency are going to stay, and those who can't are going to get wiped out. And so,
Yep.
in the times like this, I would, one of the things that I would watch out for is, well, first of all, can a company that you are purchasing, that you are interested in, can it withstand the tidal wave of technology innovation, or does it have to continuously put capital into the business to stay on top of? If you don't, if you find a business that doesn't require that kind of innovation and capital investment, that's good. And that's one of the things that Warren Buffett looks for is a company
Yep.
that can just run and generate cash. It's not very risky. It's not it's not exposed to the technology risk. But if you don't find those businesses, then you have to think about, can this company innovate at the pace that it needs to be able to keep up with the market condition? That's another thing that I would look for. If that's what I'm looking for. Yeah.
Yep.
Any closing thoughts here as we wrap this up?
Yeah. I think, Chat GPT and other things are going to be here to stay, right? I think they are going to have a tremendous impact. Like, the newest version I'm seeing, you can actually have it ingest a lot more words, right? So you can essentially have it, give it an entire body of text and then just say, please, go reformat this, or rewrite my thing to be more, funny or whatever, right? And it does it, right? So, there's a lot of benefit to this kind of stuff. You can produce content faster. You can, if you're starting a business, you can make blog posts quicker because you can have it, kind of take in some of your notes and then just output something for you, right? So what I think is this is going to drive is a lot of, like, a lot of people like start their own businesses and things like that they don't need expensive marketing budgets or expensive, they can write their own blog post, and instead of it taking 2 days to write a single blog, right, they can knock this out in, as fast as they can come up with the prompts that they want to write.
Yeah, exactly. I think it's not just a blog post. It's about, one of the scariest things is you can actually make it to do code. Like, you can actually develop things. You can say, "Oh, write me a Chrome plugin that does this and this and this," and it'll do it for you. So
Right.
I think what we're seeing now, in my opinion, is it's just a commentary on how things could play out. Is in the past we had to be in a big organization, and there was this coordination cost, and the company provided this umbrella resources to do work.
Yeah.
And this is not something new. It's been going on for a while. The gig economy stuff, right? Everyone is sort of picking work as they want, and the whole freelance movement. That happened maybe, like, 10 years ago. This is only going to turbocharge this, in my opinion, where the traditional form of work, where you have to go work for a big corporation, that model might change. This is just a commentary. It doesn't have anything to do with investing, but it's just my thinking on how this could play out in the future.
Yeah. I think there's going to always be, right. I think a lot of people think disruption happens immediately, right? And I think it'll take 2 or 3 years to play out, but a lot of the groups that are not innovating are going to get, disrupted, right? And sometimes the innovation is prevented, like we said, in healthcare or in, education and stuff like that. What we're going to end up seeing is, people are just going to say, well, the value of my degree is no longer, worth it, right? If you're making me pay $30,000 a year, and it'll take me 25 years to get out of the college, loan that I had, right? Meanwhile, I'm only making 50,000 a year. I'm just going to skip all of that, start my own business, and go, right? And I think that's happening now, and it's going to accelerate.
Yeah, definitely. All right, that was it for this episode. If you guys, again, liked what we had to say about the state of the economy and AI, if you enjoyed the episode, please like and subscribe and leave us a review on Apple podcast or wherever you get your podcast. And if you guys want to interact with us, definitely check out our website. We have a lot of free resources there, including the database that we showed earlier, valueinvestor.org. And if you guys want more, feel free to check out our membership. We're gonna hang out there and talk about companies that we like to invest in. So that's that. All right, thanks everyone for joining. I'll see you guys in the next episode.
Thanks.